Welcome to Personal Finance Deep Dives, where we help you make your money work for you. Today, we are diving into one of the biggest, if not the biggest, financial decisions of your life: buying a home. We're going to go way beyond the sticker price to get to the true cost, because what you don't know here can and absolutely will cost you thousands.
You know, I hear this sentiment all the time. Someone says, "I'm just trying to figure out the actual cost of a first home." It just gets right to the heart of the matter, doesn't it? Everybody obsesses over the down payment, but the real story and the real cost goes so much deeper than that sticker price.
All right, let's just bust the biggest myth right out of the gate. Your down payment is not your only major upfront cost. Not by a long shot. There's another huge expense that completely blindsides so many first-time buyers, and it's due the day you finally get the keys. I'm talking about closing costs. And these fees can tack on an additional 2 to 5% of the home's purchase price. Now think about what that really means for a second. On a $300,000 home, you could be on the hook for an extra $15,000 in cash, right at the finish line. Ouch.
So what exactly are you paying for with all that money? Well, you can think of it as the cost of doing business. These fees cover all the legal and financial heavy lifting that's required to officially transfer the property from the seller to you. It's the price of making the biggest purchase of your life legit.
These costs cover absolutely critical steps, like the appraisal to make sure the home's value is what they say it is, the inspection to find any hidden problems, and title insurance to protect you and your claim to the property. It all adds up. And that brings us to takeaway number 1. Your true upfront cash need isn't just the down payment. It's your down payment plus thousands more in closing costs.
Okay, so you did it. You made it through closing. Fantastic. Now let's talk about that monthly payment. Because just like the upfront costs, that mortgage bill you've probably budgeted for so carefully, it's a little more complex than it first appears.
You see, your mortgage payment isn't just one thing. It's really a package deal, and we call it PITI. That stands for principal, interest, taxes, and insurance. Principal is what pays down your loan, and interest is the lender's profit. But here's the key. Your lender also often collects your property taxes and your homeowner's insurance, puts it in an account called escrow, and pays them for you. So this combined payment, PITI, is your real monthly bill. And this brings us to the kind of tough reality of how loans are structured. It's called amortization. In the early years of your loan, the vast majority of your payment goes straight to interest, not to building your own equity. Just look at this example. In month 1, a measly $178 goes to your loan principal, while over $500 is pure interest for the bank. It takes years before your payments really start to build significant wealth for you.
And that brings us to takeaway number 2. Your monthly payment is PITI, and because you pay way more interest up front, building equity is a really slow process at first. For those first several years, you're pretty much just paying off the interest on the debt.
So we've covered the upfront costs, and we've covered the monthly bill. But now we have to talk about the hidden iceberg of homeownership. This is the whole other category of costs that frankly go on for as long as you own the home. And these are the expenses that can really catch you by surprise.
Imagine this scenario. Your main water line fails, and your dishwasher gives up the ghost. All in the first 6 months. It happens, and it can wipe out a cash reserve in an instant. You have to remember, things will break. From plumbing to appliances, houses need constant upkeep. And that's on top of utilities, yard care, and furnishing all that extra space you now have.
This requires way more than just a standard emergency fund. And that brings us to takeaway number 3. You absolutely must budget for these never-ending costs. A good rule of thumb is setting aside at least 1% of your home's value each year, just for maintenance. On a $400,000 home, that's over $330 a month set aside just for when things go wrong. Right, so when you add all of these costs up, you got the closing costs, the full PITI payment, the ongoing maintenance, it becomes pretty clear how people can fall into a really dangerous financial trap.
This quote, it's blunt, but it gets to the core of it. Houses eat money. When you don't plan for all these costs, you risk becoming house poor. And that's a situation where your home consumes so much of your income that you can't afford to live your life or, save for the future. your beautiful home suddenly becomes a financial prison.
And this is exactly why buying is not automatically the best financial move for everyone. Renting frees you from those maintenance risks and those really high transaction costs, which could let you invest the difference instead. The right choice here depends entirely on your personal timeline, your financial situation, and frankly, your tolerance for risk.
And this brings us to our final takeaway. Number 4. A home is a massive financial commitment that impacts your entire financial life. It's not just a place to live, it's a complex financial machine that you have to operate correctly if you want to succeed. So let's just do a quick recap of the 4 key takeaways we've covered. Number 1, your real upfront cost is the down payment plus another 2 to 5% in closing costs. Number 2, your monthly payment is PITE and you're going to build equity very, very slowly at first. Number 3, you must budget for the constant drumbeat of maintenance and repairs. And number 4, a home is a huge commitment and it is not a guaranteed financial win over renting.
So, the big question is a house just a place to live? Or is it the biggest financial machine you will ever operate? The truth is, it has to be both. And understanding its true cost is the first step to making sure it builds your wealth instead of draining it. That's all for now, folks. Please like, share, and subscribe for more like this.
Welcome to Personal Finance Deep Dives, where we help you make your